Hello Sector Watchers, welcome to the show. This is the 95th episode of Sector Spotlight for Tuesday the 7th of September, recording it on Monday the 6th. In the US, that's Labor Day, so I hope everybody is enjoying their long Labor Day weekend. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands as usual. If you want to stay in touch, please use any of the handles on the screen. Wow. You've got Labor Day weekend. We had an orange weekend. And if you thought that King's Day in the Netherlands means a sea of orange, then what happened last weekend was like, I don't know. We have never seen anything like that. We had for the first time in 36 years, we had the Formula One Grand Prix coming back to the legendary Zandvoort F1 circuit. And I don't know if you follow motorsports, if you follow the Formula One, then you may know that there is this guy called Max Verstappen. He's a Dutch race driver, and he is now for the first time ever contending seriously about the World Championship. And first Grand Prix in Zandvoort after 36 years means a big celebration in the Netherlands. Now, I don't think I can show you the footage from the Formula One website, so if you want to go there, go to f1.com and look at the finish of Max or any other imagery. But I guess I can scroll through the trending topic #DutchGP on Twitter. And well, I mean, this image here, this is when Max finishes, and you can see the crowd here. That was 70,000 people, pretty much all in orange. This was seriously unheard of, and that was an epic weekend. So I seriously hope that you enjoyed and you're enjoying your Labor Day weekend. I sure enjoyed my Grand Prix weekend. Anyway, let me know in the comments what you think of it, if you follow it. I'd love to discuss it, as well as comments on charts and relative rotation graphs, of course. Okay, let's start with the more serious bits and pieces. We're going to start with an overview for asset classes, then we do sectors, and then I want to go into the group thing. So we're gonna go from sectors into industry groups. I got some questions about that and how I did it, so I'm going to show you again, because repetition allows us to let more people in on that top-down analysis, how you do it, where you can find it, and see if we can find any interesting groups. So let's get started. Let's start with a quick look back on the rotations of last week. As usual, we start with asset classes. I have the daily rotations on the right and the weekly on the left, and you'll see why I did that later on. Usually I go to the charts and then I have to flip my weekly to the left and my daily to the right. So now I thought, you know, let's just start with the daily on the right and have the weekly on the left hand side. Last week, outstanding week for real estate. V&Q gaining 3.7%. That's way more than VBINX, which is our benchmark, which gained 40 basis points. By the way, VBINX consists of stocks and bonds, so real estate is not included in that index, which, by the way, makes real estate a great asset class to actually beat VBINX if you want to make that your benchmark. It's a benchmark that is used by a lot of RIAs, as it is a 60-40 balanced index, which a lot of people use as a benchmark for their managed portfolios. Now, V&Q 3.7, I think that DJP, commodities 0.9%, GSG is lagging a little bit, gained 30 basis points. ITOT stock market continues to creep higher, up 60 basis points last week. And if you look at the rotation of the tails, then you see that obviously V&Q pushing into the leading quadrant, and ITOT continues to do that. Rotated back into the leading quadrant from weakening. So maintaining its strength there, and you see GSG and DJP, the commodity tails, getting back into the swing, at least on the daily RRG. Now, if we translate that to the weeklies, then there's not a lot. Well, it did change a little bit, but not in terms of the stock market tail. ITUT continues to creep higher, still inside the weakening quadrant, and the fixed income related asset classes here on the left hand side, and they're rotating back towards or already inside the lagging quadrant like high yield. Commodities starting to creep up, so it looks as if you know that we labeled that big turnaround in commodities. I do believe that it is still there. The last few weeks, the tails on the RRG were moving from leading quite rapidly into the weakening quadrant with quite long tails, and you can see that those tail lengths are now shortening, and DJP has already started to curl up. Hopefully GSG will follow suit. I think it will. And then we could see a renewed move higher, at least relative to VBINX, for both commodity ETFs. I got a message from someone who wrote, who said, I can hear the frustration in your voice about the markets. And I think that's right, because you know, we've been talking about this risk in the market for a while now. And my view is still the same, and it, you know, we see ITUT moving higher, we see the tails here moving higher, so it's undeniable that the stock market is still rising. When we discuss the monthly trends, I think it's very clear that the market is still in an uptrend. All these monthly charts are in an uptrend. By the way, I got another message from someone who said, so I hear you talking about all these sectors on your long-term outlook on the monthlies, and it's all uptrend, 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 except for energy. So how do I pick my right sectors? Now I still need to respond to that person, but I want to make one thing clear. When we talk about the monthly charts here on Sector Spotlight, we're looking at the absolute price chart, so there's nothing relative about those trends, because otherwise, you know, he's right. I mean, if everything goes up, how can you distinguish? So that monthly recap using those monthly charts, you have to maintain that long-term view, and once a month going over these monthly charts, at least for me, it's a very good exercise to remind you what's really going on in the markets. And when you go over these monthly charts for all the sectors, then you know, they're all still in very strong uptrends. But the point that I try to make in that show is that yes, we're all in uptrends. However, there is quite some significant downside risk in all these monthly charts, and it's just an overall view for the market. It's not, those monthly charts are not going to help you with sector rotation. They're not going to help you to pick the right sector. We really need to work with the weekly RRGs and even the daily RRGs to make that work. So I hope I can make that clear, that the review of those monthly charts is nothing more, but also nothing less than just to remind ourselves of what's going on from a longer term perspective. And especially last week with the whole list of all those you know, downside, I call it downside risk, but what it actually is that all those sectors can drop that many percentage points without harming those uptrends. And as soon as those percentages get really, really big, which I think they now are, then you're exposing yourself to quite some risk if you're getting into the market right now. And I really seriously wonder whether that is worth our while, and that's the point that I'm trying to make. So I hope that's clear right now. And the frustration is definitely there. Let that be clear. I mean, I still am looking at this market thinking, when is this going to stop? Maybe it will never stop. I don't know, but we'll see, and we'll get a little bit deeper into that when we start looking at sectors and sector rotation, because I still think that there's a message to be seen and to be heard there. Nevertheless, ITUT curling back up to leading, bonds rolling over insight improving and high yield even already in lagging. So the preference, longer term preference, even from the RRG, stocks over bond, still very, very clear. Now, one chart that we need to discuss is the one of the US dollar. A few weeks ago, well, I'm never convinced, but I thought that I saw a pretty strong signal for the US dollar. And we looked at the US dollar index and the euro dollar exchange rate. And in the US dollar index, it seriously looked like we had a break of a double bottom, which would send the dollar index significantly higher. Now, since then, US dollar index has dropped back below that breakout level and is now approaching the previous low. And for the dollar index, that low is 91.78, let's say 91.75. Very often when a price pattern executes and then rapidly thereafter reverses, that's a pretty strong sign for a reversal. So I'm going to watch. We're not there yet, but if 91.75 breaks to the downside, I think that the dollar index could go back all the way to these lows, which is pretty contrary to what you would think about completing that double bottom. Now, if we go to the euro dollar exchange rate, which is my preference because it's a really traded thing, and you look at the weekly, and I created the line chart of that pattern. Let's go back to the price bar because that was the chart that we were working from, and that's when we called that head and shoulders completion here 2 weeks ago on the week starting the 16th of August. After that low, we reversed, and last week, so the week prior, we closed up at the neckline, and now last week we jumped back above it, and we're touching that dotted line here. Now, where does that dotted line come from? That is coming from when you would use only closing prices for US dollar, euro dollar, and it's getting close. I mean, there is this. I think the odds are getting smaller, but there is still the possibility that we put in a new high here and we resume our decline. Then I'm gonna tentatively say that head and shoulders pattern is still valid, but I am starting to take into account that we're going to see a reversal here when in euro dollar closing price here is 118.71. We're already trading above it right now. And you can actually see that in more detail when you look at the euro dollar daily chart, and it's 119.10. So at the moment we're off that high already, so we're trading below 119. But it's getting tricky for euro dollar and for the US dollar, whether that significant move higher for the dollar index and significantly lower for euro dollar is still going to materialize. So more careful, more caution for this move. It's getting less and less secure. It's getting less and less sure that pattern is actually going to work out. So we're going to keep an eye on it and come back to it in coming weeks when we do sector spotlight. Now, that's it for the asset classes, and we are going to take a deeper dive into the sectors and the sector rotation that we saw last week. Looking at the sector landscape, we have the weekly RRG on the left-hand side, and we've got the daily on the right-hand side. Now we had a good week for the market. S&P went up 60 basis points, and if we look at the tails and if we look at the ranking of the sectors, then we see, as we saw in asset classes, that real estate is at the top of the list with a 4.1% gain, followed by healthcare 1.6, staples 1.5, utilities 1.4. And then comes discretionary, communication services, tech, and financials is at the bottom of the list with a loss of 2.4%, energy down 1.4%. If we look at the weekly very quickly, then we see the image, which is pretty similar to as we've seen it for the last couple of weeks, with only healthcare and technology inside the leading quadrant. Real estate rolling over, but still very high on the RS ratio scale. Communication services now getting closer to crossing over into lagging, and still a pretty high concentration of sectors in the lagging quadrant. So getting back to that piece about being frustrated with the market, or maybe frustrated is not the right word, maybe it should be confused, because we look at this classification like offensive and defensive, or cyclical versus defensive. And we all know sort of kind of which sectors are cyclical and defensive, but there's actually an index. MSCI actually classifies those, and they've got a cyclical and defensive sector indexes, and they've got a methodology for that. Now, the only thing that I want to go over right now is the classification, which sectors, according to MSCI, and these are very smart people who are way above my pay grade in terms of classifying stocks and sectors, but they see the following. They see I want to go here. The defensive sectors are staples, energy, healthcare, and utilities. All others are considered to be cyclical or offensive. So defense, staples, energy, healthcare, utilities. Keep that in mind. Make a mental memo. Staples, energy, healthcare, utilities. Those are the defensive sectors. Defensive sectors are expected to do well when the market is not so strong. Now look at last week's performances and rotations. Real estate, top of the list. But then healthcare, staples, utilities, 3 out of 4 defensive sectors are topping the list with 1.4, 1.5, 1.6. The other one is energy, which is at the bottom of the list, but energy is going through a really weak stint right now. So the very clear defensive sectors are topping the list. That's confusing. And if I look at the chart here, then especially with what's going on since 2020, I think, again, I'm not probably not the right person to make that judgment call, but I argue that a good case could be made that technology, and then especially big tech, but that is driving technology, can be seen as a defensive sector. So the market is rising on the back of defensive sectors. You look at the rotations, you see a ton of sectors inside the lagging quadrant moving lower on the RS ratio scale, which means losing relative strength versus the S&P 500. There's very few sectors rotating at a strong RRG heading. So that's utilities, pretty much only utilities is at a strong RRG heading. Even discretionary staples is going down. So where does all this performance have to come from? The base of the market is getting narrower and narrower and narrower. And one chart that I created that I want to share with you is the one of the new 52 weeks highs in the NYSE index. And what you see here is that level has come off dramatically since, and this is May. So since May, the number of new 52 week highs has dropped from 700 to below 400. Now, obviously, this is not a, ironclad, graved in stone rule, but if you look at when that number, and this is a moving average, by the way. The opaque thing is the actual number, but that's very, very wild. So I drew a 12-week moving average of that 52-week new highs index, and you can see when that level drops off, when that moving average drops off, you see that there is, not always, but very often, a dip in the market. Not always major, but here again, you see it's dropping. You see that decline in the market. Here you see it's a longer period and you get a decline in the market. Here you see it's rapidly, you got this decline in the market. Here you got a decline. Here you got a dip in the market. And here is obviously that dip in the market was very, very rapidly, but it dropped here. And now we are sort of seeing a divergence between the two since May. So for me, that tells me that the base for the current rally is getting smaller and smaller and smaller. And when your base is smaller, your risk is increasing. And that's all that I'm trying to say. And from an investment point of view, I'd rather miss a couple of percentage points to the upside than getting caught in a big decline on the downside. And that's pretty much my position at the moment. I'd say I'm sort of neutral. I don't want to be 100% long in this market with these risks at the moment. A couple of weeks ago, I started to use more groups. So instead of the sectors, I go one step further and take a look at the groups that are inside a sector. So the whole market is divided into sectors, and every sector is subdivided into a number of groups, industry groups. And the easiest way, I think, to find those groups is on your dashboard, find the sector summary, or go straight to the sector summary page. And what you'll find there is a table with all the sectors. And at the end of the line of each sector, you will find an RRG icon. And that allows you to very quickly bring up an RRG of the various groups that are in a sector. So here's discretionary, that's got a lot of groups. If you go to real estate, you'll find that that has a little bit less groups. And the one that I want to focus on now is on utilities, because that is the one that's on a nice RRG heading. And it's a defensive sector which is doing quite well right now. So if we bring up the RRG for utilities, then we see that it consists of 4 groups, 1, 2, and then 3, 4. And on the plot is also the sector index itself, and the benchmark is the S&P 500. So the S&P here is the center, so the position of utilities is exactly the same as you will find it on the RRG for sector indexes. So we can immediately see the strong move for the US water index powering into the leading quadrant. You can also see the strength, the picking up of strength for the conventional electricity index. Now, if you want to bring it to the sector level, we can change the benchmark to XLU. Now watch what happens. XLU is here. When I hit enter, the chart will be redrawn. Utilities is now the center of the chart. That's the benchmark. And you see that the water index is now 4 to the right. And you see that conventional electricity remains relatively the same position. It's on a nice heading inside the improving quadrant. So taking it one step further down to the bottom of the pyramid, to the individual charts, we can do 2 things. Well, it's very clear that the red ones here, so multi-utilities and gas distribution, are, from a relative point of view, now underperforming the sector, so not very interesting. So I want to focus on the water index and conventional electricity. Now the water index has already made a big move. So where can I find probably the best value? Most likely inside the conventional electricity index. I need to find the stocks that are inside the conventional electricity index. I actually wrote an article about that a couple of weeks ago, and I'll put the link in the description of this video. So you can look back and you can do that exercise for yourself. In my chart list, I have the composition of that conventional electricity index right here. So this chart list holds all the members of the conventional electricity index. And I can look at that as an RRG right away from that list. So here are the names that make up the conventional electricity index. NRG, inside leading, starting to lose, but here are NEE and ES. Those are long tails and powering right there. They have my interest. Now I can actually bring this chart to XLU as the benchmark. Do it like that. And then I can see that NEE and ES keep their interest. Energy is rolling over. And as a final step, I can actually make that group index the benchmark. So that's dollar DJUSVE. And now I can see that NEE and ES have just crossed into the leading quadrant and they're powering right in there. So these stocks are now on my watch list and I want to look at them. How do I do that? I can just control click on NEE and control click on ESS, and there are my two names in the conventional electricity index. And look at this. This one is pushing against 80, just above 86. And you see the relative strength starting to curl back up and the RG lines are picking up. ES, looking to push against resistance. If it takes out this overhead here, very interesting. Coming out of a long downtrend from a relative point of view. So going from a sector to the groups, to the individual stocks from your dashboard, using RRG at various levels, I can pick some very interesting individual stocks. Before we wrap it up, I would like to let you know that at noon today, so that's an hour from now, I will be joining Erin Swanlin in her Decision Point live trading room. You know that Erin and her father Carl are hosting the Decision Point show on StockCharts television. They have a very good blog here as well. They're big contributors. This live trading room is not on StockCharts television, but you can register for free and attend this online webinar with Erin, who is hosting it, and I will be a guest. What she does in the show is we'll take live symbol requests, and I'm honored to be her guest. And what we'll do is she'll be hosting the show. She'll be taking the symbol requests and I'll be putting them on an RRG, and together with Erin we'll go over those symbol requests using RRG and then her input from a decision point of view. So if you have some time left, please join us an hour from now at noon Eastern. You can join us and register at the link that will be put in the description of this video. Ladies and gentlemen, this wraps up Sector Spotlight for this week. Thank you very much for watching. I hope you enjoyed the show. If you did, thank you very much for the thumbs up. And I sure hope to see you again next week at Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.